Bruce, pretty interesting paper this morning. Two big stories on insider trading activities. SAC Capital Advisors are heading for at least $1 billion settlement with the feds. And Mark Cuban, owner of the Dallas Mavericks and everybody's favorite billionaire, was found not liable in his insider trading case. So, it seems like for the feds, this insider trading thing has become the crime du jour. There's a lot of prosecution going on. Why now? What's going on?
Well, Dan, you're absolutely right. We've seen an increased focus on insider trading cases. They appear almost every day in the New York Times or Wall Street Journal. I think there are three main reasons why we're seeing an increased focus on insider trading of late. First, there's been a significant change in the leadership of the Securities and Exchange Commission. Now it's led by Mary Jo White, an aggressive former federal prosecutor who worked as the United States Attorney in the Southern District of New York. She brings an aggressive prosecutorial focus and doesn't treat insider trading violations or securities fraud violations as merely a regulatory matter, but rather she brings a sort of criminal focus on it. And her aggressive style is really striking some fear into the hearts of many businesses. The second reason, I think, is that fundamentally there's a lot of money in these cases. In cases like SAC Capital, as you rightly pointed out, the amount of money at issue is potentially in the billions of dollars, and it may settle for something like $1 billion, but the feds were threatening to come after the entire pool of money in the almost up to $10 billion, because there really had been some intermingling of funds that were allegedly gained through ill-gotten means, and then that was commingled with funds that may have been lawful. So there's really a lot of money in these cases. And the third issue, I think, is that it's really one of these types of cases where the public can understand why these companies are being targeted. It really goes to the core of the fundamental fairness of the market. Insider trading is premised on the idea that it should be unlawful for people to gain an unfair advantage in the market when you and I wouldn't have that same informational advantage.
And it seemed to me, from what I've read, that Mary Jo White has made her intentions pretty clear. She let it be known there's a new sheriff in town, and I think there's a lot of intimidation going on as well.
I think that's right. I don't know that the goal is to be intimidating. It's rather to try to set up a deterrent effect. What we really want people to do is pay more attention to how they're gathering their information, how they're pressing their sources and analysts for information, and really trying to fundamentally strike to the core of what it means to have a fair marketplace.
Well, I think she's doing a good job of that. Bruce, our friend Mark Cuban, Dallas Mavericks owner, got off scot-free. And when you and I talked the other day, you thought this was a slam dunk, that the SEC was going to get him easily. So what happened?
Well, the Mark Cuban case is a civil case that was brought by the Securities and Exchange Commission against Mr. Cuban, involving the allegations that he received a tip of some non-public material information related to the fact that this company he was invested in, Mama.com, was going to start soliciting private placements. This would have meant that his stock price would have gone down. He received this tip from the CEO of the company. The company CEO allegedly told him that he should keep this information confidential. This was a 9-year-old conversation. Shortly after he received this information and before the private placement actually happened, Mr. Cuban sold his shares and as a result avoided a loss of some $700,000. And the question is, did he receive material, non-public information that he should not have received? Now, for him to be civilly liable, the SEC would have had to have shown that he was either a temporary insider of the company, that the CEO had given him information that was non-public in confidence, and that for at least for purposes of that information in that time period, he should be considered an insider of the company and subject to the same restrictions against insider trading that the CEO himself was subject to. The alternate theory is that he might have been a misappropriator, effectively a stealer of that information, if he had promised to keep that information confidential and thus broke his promise, his duty to keep that information secret and not trade on it. Unfortunately, the SEC's case unraveled due to largely a lack of evidence. The SEC did not have jurisdiction to subpoena the CEO of that Canadian company to come in and give testimony in court. So the SEC decided to proceed in what is effectively a he said, she said situation based on a videotaped deposition of this CEO explaining what this 9-year-old conversation, what had happened and whether Mr. Cuban had in fact promised to keep that information confidential. Of course, that makes a pretty significant advantage for Mr. Cuban to come into court, be charming, and explain to the jury that's just not how it happened.
And the case was being held in Dallas?
That's another factor here. The fact that the civil jury trial happened in Dallas, where he is incredibly popular, surely had some effect on the jury's opinion here. I think it might also have been a function of a little bit of jury nullification going on there. The jury's saying, look, we hear what the law requires here, but ultimately we don't feel that this is the type of behavior that ought to be punished.
Well, I'm sure all the Dallas Maverick fans are in a joyful mood today.
I'm sure they are, as is Mr. Cuban.
As is Mr. Cuban, right. So, Bruce, let's get into this SAC Capital Advisors case because it's a little more complicated. The deal is a little more sophisticated. It seems like one of the SAC traders developed a relationship with a doctor who was running a clinical trial for a couple of pharmaceutical companies and passed that information about how the trial was going back to the trader. Now, there's an argument that could be made, I wouldn't make it, but it could be made that that's just good, hard research by the trader. So how does that become a crime?
Well, I'm glad you raised the SAC Capital situation. So as you know, SAC Capital is an investment fund that runs a number of hedge funds, basically large pools of money that they use to invest for both themselves and for other outside investors. Now, the SAC Capital situation, and I call it a situation because they've got a number of cases going on. Cases that are criminal cases by the Department of Justice and civil cases by the Securities and Exchange Commission. A few months back, there had been a civil case against SAC Capital involving allegations of insider trading, including some of the issues that you brought up with this doctor and Wyeth and Elon. That settled, as you know, for about $600 million. But unfortunately for SAC Capital and its founder and main owner, Mr. Stephen A. Cohen, that didn't wash away his problems. He has now been criminally, he's been civilly charged individually by the Securities and Exchange Commission for failure to supervise his employees, his portfolio managers and his research analysts. His company, SAC Capital, has now also been criminally indicted for violating federal securities laws. And that's the case you were talking about earlier that may, in fact, end up being resolved through a guilty plea by the company and the payment of something like $1 billion. Now, the allegations stem from work that was done by these research analysts and these portfolio managers. Now, ordinarily, we want them to go out, find pieces of information, and use that information to form a reasonable decision about whether or not they should invest in a particular security.
Yeah, but you want to find public information, right?
You do want to find public information, and this is part of the problem. One of the portfolio managers at SAC Capital had formed a relationship with a doctor who was being paid by a pharmaceutical company to effectively oversee and run a pharmaceutical drug trial to determine if that drug was in fact safe. If it turns out the drug is safe and effective, the stock price of that pharmaceutical company will go up. So basically one of these research analysts and portfolio managers formed a relationship with this doctor. He went through what's known as an expert network firm, where hedge funds typically go out and they try to have someone who knows the area or the industry or sector a little better to provide them with little pieces of information. The problem is, here this portfolio manager allegedly paid about $180,000 to this doctor, and in return, the doctor violated his duty to keep this material, non-public information, secret and within the company for the time being. So this is one of the allegations that's really getting SAC into potential trouble here. If it turns out that, much like some of the other research analysts and portfolio managers who did this type of research and traded, if it turns out that they violated insider trading law, then under corporate criminal liability principles, the corporation, that is SAC Capital itself and its various investment vehicles, will be held liable for the acts of their employees when committed in the scope of their employment.
So this doctor, because he was working for Wyeth and Elon, was what would you call it, temporary insider?
I would say for the time being, while he's being paid to run this drug trial by Wyeth and Elon, he's under an obligation, much like the CEO of those pharmaceutical companies would be under, not to reveal to any outsider material non-public information. If he reveals it, it violates what is called his fiduciary duty, his duty to keep loyal and to keep the confidential information of his company.
And the way I understand it, from what I've read, is he actually sent an entire PowerPoint presentation to this trader with the full results, and the trader then at SAC Capital began to unwind their positions in both Elon and Wyeth, saving themselves stock losses in the hundreds of millions of dollars.
And this is, you've hit on exactly one of the most important issues of this case, and what might separate this case from other situations of hedge fund analysts trying to find little pieces of information. Federal law requires that in order to be convicted of insider trading, you have to purchase or sell a security on the basis of material, non-public information. Material information, the Supreme Court has said, is information that a reasonable investor would find substantially likely to alter their decision of whether or not to purchase or sell a security. In a case of getting one small tidbit of information, that's not likely to sway the decision of whether to invest or not for a reasonable investor. In the case where you actually have the full PowerPoint slide telling you what the study is going to look like, that's very material. And the fact that research analysts and portfolio managers at hedge funds seek so aggressively to get that helps to kind of prove the materiality case.
Yeah. Well, it looks like we won't have Stephen A. Cohen and SAC Capital Advisors to worry about too much.
Yeah, it sounds like he's probably going to pack up shop, get rid of his outside investors, and merely manage his own money for himself.
Poor guy. Down to his last $10 billion. Bruce, I want to bring up another issue now that apparently is not insider trading, but it sounds a lot like this other stuff. Apparently, Thomson Reuters, a news organization, has for years been paying the University of Michigan, the producer of one of the most important and influential consumer confidence surveys, $1 million a year to give Thomson Reuters the opportunity to distribute that to their paying clients 5 minutes before it goes public. And then they took it a step further, and for some more money, they could put it out to premium high-speed traders 2 seconds in advance in machine-readable form, right? But there's nobody saying this is insider trading. So what's the difference?
Well, this is a really interesting issue that's come up of late, and it's gotten a lot of attention by people, including the New York Attorney General. Basically, it looks a lot like insider trading. It seems like you've got an outside company, Thomson Reuters, paying another entity for inside information, essentially very material information. It does move the markets. It's non-public at the time that Thomson Reuters receives it, and then distributes it for money to its paying subscribers, and a little more money if you want it in machine-readable form, and you can trade on it very quickly right before everybody else gets that information. The reason it's not insider trading is because in order for there to be insider trading, there must be a violation of a fiduciary duty.
Okay.
Here, in this case, there's no question that the University of Michigan hasn't violated a duty to itself by going out and taking surveys and then selling that information.
Right.
In fact, without the money, they probably wouldn't have the incentive to produce this report that's fairly meaningful for the market. Likewise, there's no question that Thomson Reuters hasn't breached a duty to University of Michigan, right? They're paying for this information.
Yeah.
Right? And University of Michigan wants them to have this information. So there's no violation of fiduciary duty here, and that's critical to insider trading. There are, however, two other related questions that regulators are looking into now. One, does this potentially violate Regulation FD, which basically says if you have material inside information and you intentionally share it with one party, then you have to share it at the same time with every other party. Now, my sense is that that won't pan out, but there is one other potential avenue where they could get into trouble for this, particularly for that extra 2 seconds that most people didn't know about until a couple of months ago. The New York Attorney General is looking into whether this practice might constitute an unfair business practice under what's known as the Martin Act. Now, it's a very broad statute that really gives the Attorney General a decent amount of wiggle room. Now, the problem for him is he has to explain why it's not unfair for Thomson Reuters to give out this information 5 minutes before, which everybody kind of accepted, maybe unless you're Bloomberg News, everybody kind of accepted that that was okay. But why giving that extra 2-second advantage to the high-speed traders, why that is unfair. Now, drawing that line in a principled fashion is going to be the chief challenge for the New York Attorney General on this.
You know, it's interesting that the Conference Board also produces a Consumer Confidence Index about the same timing, and it has probably about the same influence. And over the years, their board has consistently decided not to make that available in an earlier time for whatever money they got paid, and they did that kind of consistently.
Well, and Thomson Reuters now, as a result of people looking into this practice, they've backed off of it for the time being. So it'll be interesting to see how this plays out.
Yep, for sure. Bruce, we've talked about a lot of different kinds of insider trading activities and some that we've decided maybe not be insider trading, but nevertheless, there's a lot of pressure on the business community from the SEC, the Department of Justice, and others. Is this pressure going to continue? Might it abate? Is it going to get even more intense? What do you think?
I don't think it's going to abate anytime soon. I think federal regulators at the Securities and Exchange Commission and federal prosecutors, particularly in the Southern District of New York, they are really trying to send a message of deterrence to the business community. The way to send a message of deterrence is to tell the business community that if you get caught, you're going to have to pay a large sum of money. Now, billion-dollar settlements, billion-dollar plea bargains are not uncommon. Likewise, they're trying to send the message that we're watching you. No matter how big you are, you're not too big to be indicted. And I think that's the message from the Cohen case. Now, I think they're also trying to tell the business community following the letter of the law is not enough. Merely getting as close as you possibly can to that line without going over, that's a very risky business strategy. They're trying to tell the business community to focus on ethics more, focus on the spirit of the law, focus on making sure that you're hiring people based on their character, not just their connections. So I think we're not likely to see this abate anytime soon.
Well, they're sure getting that message out strongly and clearly, I think.